Congratulations, you have your infinite banking policy. The work is done. You've had your conversation with the expert. They've made a professional recommendation based on the money that comes into your ecosystem rather than just asking how much you can set aside for this policy, and structured it accordingly by reverse engineering it to make sure that they satisfy Rule 7702 by purchasing the minimum amount of insurance based on the amount of cash that you want to run through the policy, because this is leverage, not set aside money. A couple things that I want to make sure that you were made aware of when you structured your policy. The first thing is that it's a whole life policy with the mutual insurance company, similar to doing business with the credit union, where the health of your policy is not based so much on external factors, but on the financial well-being and strength of that specific company, because it's a redistribution of profits and revenue, not an overpayment of premium like they would have you think. The second thing that I want to make sure that you understand and that you do have is 80% liquidity. What I mean by that, as you can see here, means that if you put $25,000 into your policy on an annual basis, that you have access to 80% within the first year. Now, it doesn't have to come in a lump sum. You can put it in any denomination, any frequency that you see fit, but you should have access to about 70 to 80% of it within a couple of weeks. Ultimately, at the end of the year, between 80 and 90% liquidity in the policy that you can actually borrow from now, not 3 years, 5 years, 7 years down the line. The other thing that I want to make sure that you understand is that you get a cash on cash return somewhere around year 3, 4 at the very latest. And what I mean by that is that two things: that your dividend amount that grows in the policy surpasses your annual premium. So here, premium is $3,600. In year 4, your dividend is not guaranteed to be, but they haven't missed a dividend payment in over 120 years, but it's at $3,500. So almost, but you see in year 4, you have a situation where your dividend has surpassed your premium. So it's basically a wash. And essentially, you pay for your policy for 4 years because they're giving the money right back to you. The other beautiful thing that you want to make sure is that you have a cash on cash return in your policy pretty early on. Here it happens in year 3. Sometime it doesn't happen in year 4, but you want to make sure that you're getting a cash on cash return pretty early on in your policy, where you're putting in $25,000 and you're actually getting access to $25,000 or more in that same year of the policy. So these are some of the things that you may have overlooked that may not have been explained to you with great depth, but you definitely have these in your infinite banking policy. And if you have any questions about some of the other things that you should look for in your infinite banking policy or becoming your own bank, feel free to comment or DM Bank below, and let's dig in and figure out how your policy is structured and how it benefits you specifically.